Welcome to the Daily Stock Beaver Market Briefing. Today is July 9, 2026, and we're going to dive straight into the market snapshot. Semiconductors surged 3.5% after Meta announced plans to build its own AI chips with $145 billion in spending this year alone. Crude oil dropped 2.3% as traders bet on de-escalation between the US and Iran. Bitcoin reclaimed $63,000 after a 3% slide, and the VIX sits at 15.84, signaling calm despite geopolitical tensions. Let's break it all down. The story today is AI capital expenditure colliding with geopolitical uncertainty, and markets are siding firmly with the chips. Meta's announcement that it will begin manufacturing in-house AI chips in September, backed by reported spending of $145 billion in 2026, sent ripples through the entire semiconductor supply chain. Applied Materials jumped nearly 7%. Lifting Lam Research and KLA Corp Micron Technology climbed 7% after committing up to $3 billion in U.S. chip investment. The semiconductor ETF, SOXX, surged 3.5%, the standout move on the board. Meanwhile, energy markets are telling a contradictory story. Crude fell to $71.82 as traders positioned for de-escalation between the U.S. and Iran, even though the ceasefire appears fragile. Falling oil prices normally signal calm, but gasoline and diesel markets are flashing supply stress underneath. Companies like Colgate-Palmolive have already quantified raw material hits in the hundreds of millions at elevated oil prices. And hovering over everything is Federal Reserve ambiguity. Prediction market traders on Kalshi now put a 54% probability on the Fed raising rates this year, even as the June FOMC minutes revealed a divided committee. We'll dig into what that means for bonds and your portfolio later in the show, and we'll break down gold's move to $4,100 and silver's 3.1% surge. So here's the pattern across asset classes today. Tech and semiconductors are roaring, oil is slipping on de-escalation hopes, and precious metals are catching a bid alongside Bitcoin. This is a selective risk-on session where investors are chasing AI growth while quietly hedging with metals. The calm VIX at 15.84 says the market is pricing in contained geopolitical risk, but the precious metals rally tells you not everyone is buying that story. Now let's run the board. The S&P 500 rose 0.8% to about 7542. The nasdaq climbed 1.3% to roughly 26,207. The Dow added 0.27% to about 52,487. And the Russell 2000 gained 1.22% to 2993. The VIX Fear Index sits at 15.84, firmly in calm territory. The overall market regime is neutral. On the indicator board, long-term bonds tracked by TLT edged up 0.15% to $84.49. The 10-year Treasury yield holds at 4.56%. The 30-year sits at 5.6%. The U.S. national debt stands at about $39.4 trillion, down roughly $20 billion on the day, and we'll dive deep into the federal budget picture later in the podcast. Gold rose 1.23% to $4,100 an ounce, and silver surged 3.14% to $60.38. We'll go much deeper on precious metals coming up next. Oil fell 2.31% to $71.82, and Bitcoin gained 1.66% to around $63,300. 11 sectors green, just 3 red, and the rotation story is unmistakable. Money is chasing growth and cyclicals while defensive sectors fall behind. Semiconductors led the entire board with a 3.5% gain, fueled by Meta's chip announcement and that wave of AI spending commitments. Technology broadened out too, up 1.94%, with software adding 1.51%. This is the AI infrastructure supercycle in action, lifting the entire growth complex. Consumer discretionary climbed 1.46%, and financials added 1.11%, telling you investors aren't just hiding in semiconductors. They're reaching for risk across the board. On the losing side, it's the defensive trio. Consumer staples fell 1.4%, energy dropped 1.36%, and utilities slipped 0.45%. Energy's decline tracks oil's drop on de-escalation hopes, and staples falling while discretionary rises is a classic risk-on signal, investors favoring companies that benefit from economic growth over those that sell us what we need no matter what. Now let's zoom out and see how the week has shaped up. Week in review. This week, July 1 through July 9, was a consolidation week with a quiet rotation underneath. The headline indices barely moved, but don't let that calm surface fool you. The Russell 2000 slipped 0.67% while large caps held steady, and that small cap weakness is your first clue this wasn't a clean risk-on week. Here's the thing, though. The Russell is still up 19.31% year-to-date, the best-performing major index by a wide margin. So a modest pullback here looks like profit-taking within a strong trend, not a breakdown. The sector rotation tells a much more dramatic story. Semiconductors fell 3.0% this week, the worst-performing sector on the board, despite being up a staggering 85.44% year-to-date. That's an extraordinary divergence. When a sector that's nearly doubled in 7 months suddenly lags, it's either catching its breath or running out of buyers. Given today's chip rally that we covered in the market snapshot, it looks like the former, investors were taking profits. On the flip side, energy led the entire market with a 3.67% weekly gain, driven by escalating U.S.-Iran tensions and genuine supply tightness in refined products. Industrials and materials both retreated, cyclical sectors that typically need a growth narrative to rally, and right now the growth narrative is all about chips, not factories. Two longer-term divergences are worth flagging. Consumer discretionary sits at just 0.66% on the year, essentially flat, in a year when the S&P is up nearly 10%. When companies that sell us what we want rather than what we need are barely participating, it's worth asking whether the consumer is getting cautious underneath the headline strength. The cross-asset picture sends a mixed but revealing signal about what the market is actually worried about. Crude oil surged 4.56% this week, but here's what's interesting. Gold fell 0.84%, and silver dropped 3.13%. Normally, geopolitical fear sends both oil and precious metals higher together. Oil rallying while metals slip tells you the market is treating the Iran situation as a targeted supply disruption, not a broad safe haven panic. If this were a true risk-off moment, you'd see gold and the dollar both catch a bid. Instead, the dollar was essentially flat, up just 0.11%, which signals the currency market isn't fully buying the hawkish Fed narrative that the bond market is pricing in. Speaking of bonds, long-term treasuries fell 1.0% as yields crept higher. And then there's Bitcoin, up a trivial 0.29% this week, but down 28.7% year-to-date, by far the worst-performing major asset class. The crypto bull narrative has taken a backseat to geopolitical risk and rate uncertainty. The verdict: the market rotated from growth leadership into energy on geopolitical headlines, while rates crept higher and small caps softened. The year-to-date narrative remains intact, but breadth is narrowing. Watch next week for whether semiconductors can sustain today's rally and whether the energy bid holds if Iran tensions cool. Now let's get into the commodities deep dive, starting with energy and precious metals. Commodities. The dominant commodities story right now is the extraordinary divergence between energy products and everything else. Wholesale gasoline futures are up 68% year-to-date. Heating oil is right behind at 67.9%. These aren't abstract numbers on a screen. Those are the futures prices that eventually show up at your local gas station and on your winter heating bill. On the flip side, orange juice futures have collapsed 26.4% year-to-date. The commodity market is telling two very different stories depending on which aisle you're shopping in. Refined petroleum products are squeezed tight, while agricultural softs are finding relief. Energy is where the action is, and the internal divergence is the puzzle worth solving. WTI crude sits at $71.77, down 2.4% today as traders bet on de-escalation between the U.S. and Iran. But here's the anomaly. Wholesale gasoline futures plunged 8.0% today, while still being up 68% year-to-date. When crude eases but product prices stay elevated, that points to refinery bottlenecks rather than raw crude supply issues. The market doesn't have an oil problem, it has a refining problem, and government data backs that up. The July 3 EIA petroleum report confirms the squeeze. Crude inventories drew down 6.2 million barrels, a 1.9% week-over-week decline, bringing stockpiles to about 319.5 million barrels. That's a significant draw. Gasoline stocks also fell 1.9 million barrels, and refinery crude input dipped 1.0% to 17 million barrels per day. When refineries are processing less crude, but gasoline inventories are still drawing down, you're looking at peak summer driving demand hitting a system with limited spare refining capacity. That's why gasoline futures have stayed elevated even when crude itself pulls back. Our stock Beaver positioning analysis as of June 30 reveals a fascinating split between what speculators think and what the industry knows. Big traders, the hedge funds and CTAs, are modestly bullish on WTI crude, but that position sits at only the 17.8th percentile over 6 years. Far from crowded. Now here's the signal that matters. Oil companies have their hedge books at just 12.7% of open interest, the 0.5th percentile. That is essentially the lightest hedging in our entire data set. When the companies that pump oil for a living are barely locking in prices, they're telling you they expect higher prices ahead. Why hedge if you think you're selling into a rising market? But the gasoline trade is a different animal entirely. Big traders are long gasoline at the 99.2nd percentile, levels last seen back in November 2021. Everyone's betting the same way on summer gasoline tightness, and when the crowd is all on one side at near-record levels, even a small surprise, a refinery coming back online, a demand softening, can cause a sharp reversal. The precious metals picture is more nuanced than the headlines suggest. Gold is up 1.2% today to $4,130 an ounce, but down 3.6% over the past 30 days and off 4.6% year-to-date. That pattern, a tactical bounce inside a broader downtrend, tells you the safe haven bid is weak. In a genuine risk-off environment, gold would be leading, not bouncing off lows. Copper rose 2.4% today to $6.25, yet it's down 1.1% over 30 days. The industrial metal that's supposed to signal economic growth isn't confirming any robust recovery. Both metals are catching a short-term lift from the Iran escalation, but the trend beneath is telling a different story. Our positioning data shows an interesting tension in gold. Managed money, the hedge funds, have gold longs at the 86.2nd percentile, with sentiment still building. That's a crowded trade getting more crowded. But gold mining companies are barely hedging. Producer shorts sit at just 6.9% of open interest, the 2.1st percentile over 6 years. The people who know their reserves and cost structures best are declining to lock in current prices. When the miners themselves won't hedge, they're implying they see higher prices ahead. And that's a powerful signal from people whose entire business depends on getting that call right. Palladium is our one high-risk flag across all 30 markets we track. 53.0% of open interest is short, with sentiment still turning more bearish. When more than half the market is betting the same direction, and that bet is still growing, any supply headline could trigger a vicious squeeze. The agricultural markets are quietly sending inflation signals straight to your grocery bill. Coffee futures are up 39.7% over the past 30 days, and cocoa has exploded, up 66.2% over the same period. Wheat is up 27% year-to-date, and rice futures have climbed 36.7%. These are the raw materials behind your bread, your morning coffee, and your chocolate bar. Consumer prices tend to follow futures with a lag, but sustained moves of this magnitude eventually reach the shelf. When three staples simultaneously rally at these speeds, it's not a supply hiccup, it's a structural repricing of food. In agriculture, the positioning data reveals some sharp reversals. Corn big traders were heavily bearish, but velocity surged positive by about 23,500 contracts. That's aggressive short covering, and it tells you funds suddenly see an oversold market. Coffee producers are almost completely unhedged at the 1.4th percentile of producer shorts. When the industry that actually grows the beans has virtually no price protection, any supply shock from Brazil sends prices soaring with no buffer. And live cattle longs sit at the 89.7th percentile, reflecting tight U.S. herd numbers and persistent protein inflation that isn't going away. Now let's see how the dollar is holding up against the world's major currencies. Currencies. The dollar has been strengthening against most major currencies this year, and the story is all about the Fed. The Japanese yen has fallen 3.6% against the dollar, with the dollar now buying 162.39 yen, a level that reflects a Bank of Japan struggling to control its own bond market as Japanese yields hit multi-decade highs. The Canadian dollar has slipped 3.3%, dragged down by the same commodity softness dynamic that's lifting U.S. rates. But here's the outlier. The Australian dollar has actually strengthened 3.9% against the greenback, riding commodity export strength that's immune to the broader dollar bid. When two commodity-linked currencies go in opposite directions against the dollar, the divergence is telling you something about each country's trade mix, not just about Fed policy. The emerging market picture is more divided. The Brazilian real has strengthened 6.6% against the dollar this year, the standout performer buoyed by commodity exports and an extended 12% oil export tax that's drawing capital. On the weak side, the Turkish lira has lost 9.0% of its value, and the Indonesian rupiah is down 8.2%. These are familiar stories of inflation and central bank credibility gaps. When a country can't convince markets it controls inflation, capital votes with its feet. The Chinese yuan bucking the trend with a 3.0% gain is the real surprise here, and it suggests Beijing's structural economic shifts are outweighing the dollar drag. Our stock Beaver positioning analysis reveals what may be the most crowded macro trade in the entire market. Hedge funds have piled into yen shorts at the 98.9th percentile. 42.3% of open interest is betting against the yen. But it's not just the yen. The Canadian dollar short is at the 98.9th percentile, and the euro short is at the 98.6th percentile. Three major currencies simultaneously near the 99th percentile of short positioning. That's not three separate trades. That's one coordinated bet on global monetary divergence. The thesis is simple. The Fed tightens while the rest of the world eases. And when a trade gets this crowded, it works beautifully right up until the moment it doesn't. One Bank of Japan intervention or one dovish Fed pivot, and the unwind would be violent. Meanwhile, institutional investors, the pension funds, hold significant long positions across these same currencies. The real money disagrees with the fast money, and that tension is a flashing yellow light. For listeners planning international travel, your dollar goes further than it did in January in Europe, Japan, and Canada, but less far in Australia or Brazil. The bottom line, the dollar's strength directly reflects the market's conviction that the Fed stays hawkish while the rest of the world eases. Treasury and Rates. The yield curve is telling a story of persistent inflation and a Fed that can't cut. The 10-year Treasury yield sits at 4.56%, up 12 basis points this week. The 30-year is at 5.6%, up 15 basis points. Crossing above 5% is a psychological threshold that signals the bond market is pricing in structural inflation, not just a temporary blip. The 2-year holds at 4.21%, and the curve is positively sloped with the 10-2 spread at 0.35. That's important. The inverted curve that traditionally signals recession has uninverted, but not because short rates fell, because long rates rose. That's a market saying rates stay elevated for a long time. For real people, this rate environment cuts both ways. If you're a saver, a 4.21% 2-year Treasury means money market funds are finally paying meaningful income. But if you're a homebuyer, mortgage rates have ticked up to 6.49%, and anyone financing a car faces borrowing costs that look nothing like the free money era. Treasury trading volume reached about $1.44 trillion on July 8, with 46% of that flow coming from dealer-customer transactions, rather than banks trading among themselves. That elevated dealer-customer share signals institutional investors are actively repositioning, not just passing time. And the heaviest activity was concentrated in the intermediate part of the curve, exactly where the rate hike debate is most intense. When the smart money is trading the belly of the curve, they're making a deliberate bet on the Fed's next move. Our stock Beaver positioning analysis shows one of the most crowded trades in the market. Hedge funds are heavily short treasuries across the entire curve. In the 2-year, leveraged funds are 46.0% short, flagged as moderate risk. The 10-year shows 35.8% short at the 82.2nd percentile. That's a massive coordinated bet that rates keep rising. But here's the counterweight. Pension funds and endowments are net long, with 59.7% long in the 5-year. This is the classic tension. Real money is long, fast money is short. If any data point, a weak jobs report, a soft CPI forces the market to reprice from hike to cut, that short covering would be explosive. 46% of 2-year open interest scrambling to cover at the same time is not a gentle repricing. On equity indices, the positioning tells a story of professional skepticism hiding beneath a calm market. Hedge funds are net short the S&P 500 at the 78th percentile, 17.8% short versus just 5.5% long. Meanwhile, asset managers are 40.8% long. The institutional money that actually owns stocks for the long run is still committed. But the VIX positioning is the real tell. Leveraged funds are long VIX at the 97th percentile. The professionals who get paid to manage risk are carrying significant tail risk protection. They're not buying the calm. And Bitcoin sits at 57.8% short, another moderate risk flag that rounds out a picture of hedge fund skepticism across risk assets. Connecting everything across commodities, currencies, and rates, the market has constructed a coherent but crowded macro narrative. Strong dollar, higher rates, weak foreign currencies, AI-driven equity exceptionalism. The simultaneous 98th plus percentile shorts in the yen, euro, and Canadian dollar, combined with treasury shorts at 46% in the 2-year, mean the fund community is positioned for a world where the Fed tightens while the rest of the world buckles. The counterweights are gold at the 86th percentile with producers barely hedging, and VIX longs at the 97th percentile. Not everyone is buying the calm. Meanwhile, FINRA data shows margin debt has surged to $1.42 trillion, up 53.7% year over year, while corporate bond breadth is collapsing with 878 new 52-week lows against just 266 highs. That margin credit divergence, investors borrowing aggressively to buy while corporate bonds signal distress, is a classic late-cycle signal. Our positioning analysis flags three dangers. Palladium at 53% short is the single high-risk contract. Any supply disruption forces a brutal squeeze. The two-year Treasury at 46% short could unravel rapidly on any dovish Fed surprise. And three major currencies at the 98th plus percentile of short positioning is a coordinated bet that unwinds together on one catalyst. The big money is positioned for higher rates and a stronger dollar, but the cracks beneath the surface are widening. Now that we've seen where rates stand, let's pull back and look at the bigger economic picture. What the Fed is doing, how the economy is holding up, and what it means for your portfolio. Economy and the Fed. The biggest economic mover this week wasn't a stock or a commodity. It was the trade deficit, which blew out dramatically. Right behind it, the 10-year Treasury yield climbing to 4.56%, and average hourly earnings still grinding higher at $37.64 an hour. Taken together, these three moves tell you the economy is sending a slightly tightening signal. Inflation pressures are bubbling back up, borrowing costs are rising, and yet the labor market, while softening at the edges, hasn't cracked. For anyone managing a retirement portfolio, that combination means the Fed stays parked right where it is, and your savings and money market yields stay meaningful a while longer. The trade deficit for May came in at negative $77.6 billion, a 42% jump from the prior month. That's not a rounding error. That's a structural shift, and it directly subtracts from GDP growth. The goods-only deficit hit negative $105.8 billion, missing Wall Street estimates by roughly $21 billion. And when economists miss by that much, something real broke beneath the surface. Part of this is the strong dollar story we covered earlier. A muscular greenback makes foreign goods cheaper here and American exports more expensive abroad. That's great if you're shopping for imported electronics, not so great if you're a manufacturer trying to sell overseas. A swing this large could meaningfully trim second quarter GDP when the final numbers land. The 10-year Treasury yield rose to 4.56% this week, up about 8 basis points. Here's the important nuance. The yield curve that inverted back in 2022, the classic recession signal, has uninverted, with the 10-year minus 2-year spread now at a positive 0.35%. But this uninversion didn't happen because short-term rates fell and the Fed was cutting. It happened because long-term rates rose, and that distinction is everything. The bond market isn't pricing in rate cuts, it's pricing in rates that stay elevated for a long time. For savers, that means your CDs and money market funds keep paying in the 4% range. For borrowers, the 30-year mortgage rate sits at 6.49%, a world away from the 3% era that anyone who bought or refinanced a decade ago still remembers. Average hourly earnings climbed to $37.64 per hour in June, up 3.5% year-over-year. That wage growth meaningfully outpaces the Fed's 2% inflation target, and that gap is the whole story. If wages are rising at 3.5% but the Fed wants inflation at 2%, businesses face higher labor costs that they either absorb squeezing profits or pass along in higher prices. Either path leads back to sticky inflation. For the Fed, that 3.5% isn't a victory, it's a constraint. For those of you still in the workforce, it's your raise. The Fed just wishes it were smaller. Looking at the plumbing of the financial system, SOFR, the benchmark that adjustable rate mortgages and many business loans track, eased slightly to 3.58%. A small tailwind for borrowers but not signaling any real loosening. The more revealing number is the Fed's reverse repo facility, which dropped to just $5.8 billion. During the QE era, that facility held hundreds of billions, sometimes over $1 trillion, in excess cash parked at the Fed. Now it's nearly empty. That tells you the liquidity cushion that buoyed markets has been drained to the margins. The system isn't in distress, but it's running tight, and tight plumbing means any future shock has less of a buffer to absorb it. The Fed's balance sheet ticked up slightly to $6.74 trillion this week, up about $11 billion. Within the holdings, Treasury bills increased by $10 billion, while mortgage-backed securities held steady at roughly $1.95 trillion. That MBS number is the one that hits your wallet. When the Fed owns a massive chunk of the mortgage-backed securities market, it suppresses yields on those bonds, which holds mortgage rates down. As that portfolio eventually shrinks and QT resumes in earnest, upward pressure on mortgage rates builds. The Fed's balance sheet is the hidden hand behind why the 30-year mortgage is still at 6.49%. Quantitative tightening appears paused or running at minimal pace right now, but the trajectory matters more than the weekly wiggle. Less Fed support means higher borrowing costs for you. The VIX sits at 16.9, calm territory, though it ticked up about 2% this week. But the headline number is misleading. Underneath, the tech-heavy nasdaq volatility index stands at 27.9, roughly 65% above the broad market reading, and the small-cap Russell 2000 gauge is at 22.1. Investors are paying up for protection on exactly the parts of the market that have led this rally. Meanwhile, the emerging markets volatility index is at 39, genuine fear. When the headline VIX looks calm but sector-specific volatility is elevated, it tells you investors are selectively hedging their bets. They're not complacent across the board, they're nervous precisely where the gains have been concentrated. On inflation, the freshest consumer price index data we have is from May, about 10 weeks old, so treat it as a lagging snapshot. The forward-looking signals matter more. The 10-year break-even inflation rate, what the bond market expects inflation to average over the next decade, rose to 2.25%. That's above the Fed's 2% target, which means the market is telling Powell, inflation isn't going back to where you want it. Meanwhile, the 10-year real yield, what you earn after stripping out inflation, stands at 2.31%. When real yields are above 2%, monetary policy is historically restrictive. That's a headwind for gold, a headwind for risk assets, and it reinforces why the Fed feels no urgency to ease. They're already running tight by historical standards. The June jobs report was a stunner, and not in a good way. Non-farm payrolls added just 57,000 positions, less than half the 110,000 economists expected. A 48% miss on payrolls is the kind of number that makes you sit up and ask what broke. The unemployment rate ticked down to 4.2%, and initial jobless claims held at 215,000, still in healthy territory. But here's the wrinkle that connects the dots. The number of people unemployed for less than 5 weeks jumped 31% in a single month to about 2,857,000. That tells you recent layoffs are accelerating even as the headline rate improved. The rate looks fine because the labor force denominator shifted, not because hiring is strong. Meanwhile, the number of people stuck unemployed for 15 weeks or longer actually fell 8%, a rare bright spot suggesting some long-term jobless are finally landing work. But the divergence is the story. Layoffs picking up while overall hiring slows means the labor market isn't breaking, but it's bending where it always bends first. Cyclical payrolls, the manufacturing and construction jobs that typically turn first when the economy weakens, inched up to about 20.9 million. But the composition matters more than the total. Manufacturing employment was essentially flat at just under 12.6 million, consistent with that strong dollar making American exports pricier overseas and tying directly back to that widening trade deficit. Construction, meanwhile, added workers, reaching 8.3 million, which tells you the housing market isn't cracking yet. These are the canary in the coal mine sectors. Manufacturing stall is the early signal, construction holding up is the offset. Right now the canary is alive but breathing hard. Finally, investor leverage, and this is where the story gets uncomfortable. FINRA's latest reading shows margin debt at about $1.42 trillion as of May, up 8.5% in a single month, and up nearly 54% year-over-year. That 54% number is the one to remember. Historically, margin debt surging more than 30% year-over-year has preceded major market tops, and we're now well past that threshold. The net credit balance is deeply negative at negative $992 billion, meaning investors collectively owe close to $1 trillion more than they are holding in cash. Pair that with the calm VIX and the elevated sector volatility we just discussed, and you get a clear picture. Investors are leveraged and nervous at the same time. Leverage cuts both ways. This doesn't mean a crash is around the corner, but it tells you the next downturn, when it comes, could be amplified by forced selling. So here's the one-line takeaway. The economy this week leaned slightly tighter, a wider trade deficit, rising yields and inflation expectations ticking up, all against a jobs picture that just printed its weakest number in a long time. The Fed has no reason to cut and no reason to panic. For your portfolio, that means the income side of your retirement, CDs, money markets, bond yields stays attractive, but the risk side demands respect with leverage this elevated. With earnings season kicking into gear, we'll see whether corporate profits justify the optimism, or whether the borrowed foundation underneath it starts to crack. Earnings pulse. Earnings flow was light this week. Only one sector gave us a meaningful read. Consumer defensive takes the slot, and it's a clean sweep on the bottom line. All 4 companies beat both EPS and revenue estimates. 3 of the 4 maintained guidance, and the dominant tone across the group is cautious. That tension, strong results, guarded outlooks is the story. Here's what management teams are telling investors. The sector's verdict this year is blunt. Pricing power is no longer a portfolio-level attribute. It is a per SKU, per channel, per occasion calculation, and the companies that recognize this granularity are systematically outperforming those that do not. Start with the star pupil and the laggard. McCormick, ticker MKC, posted the best post-earnings reaction in the group, shares up about 8.3% since its late June call. The CFO's team grew constant currency sales 14%, though most of that came from the McCormick Mexico acquisition. What investors liked is the B2B side. Flavor Solutions held pricing while still growing volume in the Americas, signaling genuine pricing leverage when the buyer is a food manufacturer rather than a price-sensitive home cook. Constellation Brands, ticker STZ, sits at the other end, down nearly 4.8% since July 1. The beer business beat on both lines, but management maintained full-year guidance with what they called an abundance of caution. The culprit was gasoline. A spike of more than 50% in national gas prices hit beer demand hardest in Texas and Florida, and management noted that Hispanic zip codes still lag the general population. PepsiCo, ticker PEP, reported just today and the market wasn't impressed, shares off about 3.3%. The company beat on both EPS and revenue, but the headline was pricing concessions. PepsiCo deliberately lowered prices on core U.S. salty snacks to win back volume share from cheaper rivals. International is carrying the load. That business grew 7% and is on track for about $40 billion in revenue this year, with margins expanding 100 basis points offshore even as North America compresses. General Mills, ticker GIS, posted the quietest beat, up about 3% since its July 1 call. Management is guiding to 4 to 5% net inflation for fiscal 2027 and acknowledged that broad list pricing is essentially maxed out. Their pricing power now exists only where differentiated innovation justifies it. Cheerios Protein alone is now roughly a $100 million business. The through line for this sector: every company beat estimates, yet the market punished 3 of the 4. What separates the winners from the losers isn't whether you beat, it's whether your pricing power is real or borrowed. For retirement portfolios, that distinction matters because dividend sustainability depends on margins holding up when the consumer finally pushes back on price. Now let's see how this lands on our top stock and ETF picks. Top stock picks. Our buy signal radar is lighting up this afternoon. Right now, roughly 100 stocks are flashing active buy signals across our internal models, and that breadth matters. When you see this many names confirmed on mechanical bull signals at the same time, it tells you the trend beneath this market is healthier than the day-to-day headlines might suggest. Several stocks have now held buy signals for 3 consecutive sessions, meaning the models confirmed them on Monday and haven't wavered since. IBM, ticker IBM, is on day 3 near $302. CF Industries, ticker CF, also on day 3 near $117. And Alnylam Pharmaceuticals, ticker ALNY, right there with them at about $324. Meta Platforms, Apple, MSCI, Moody's, and S&P Global round out that 3-day group. Now here's where it gets interesting. 3 of those names, IBM, CF, and Alnylam, aren't just on buy signals. They're also appearing in our swing and recovery rankings. We call that high confluence. It means the mechanical trend model and the performance rankings are telling you the same story. When both systems agree, that's a signal worth taking seriously. Jack Henry, ticker JKHY, and Fidelity National Information Services, ticker FIS, are 2-day buy signals that also carry that confluence tag. Turning to the stocks surging right now, the hottest names this week are telling a very clear story about AI infrastructure spending. Hewlett-Packard Enterprise, ticker HPE, leads the pack with a 19.2% gain over 7 days, trading around $49. The catalyst is substantial. HPE is sitting on a backlog of nearly $6 billion fueled by a new wave of AI spending. Thanks to its acquisition of Juniper last year, HPE can now sell integrated compute, networking, and storage stacks together. And some enterprise customers are actually shifting AI workloads from the cloud back to on-premises infrastructure. That's a structural shift, not a quarter-to-quarter blip. Arista Networks, ticker ANET, is close behind at 15.4% over 7 days, trading near $185. Arista is riding optimism ahead of its Q2 earnings report on August 4th, with analysts pointing to strong demand for its AI connectivity and Ethernet switching solutions. There's growing chatter the company could surprise to the upside. Dell Technologies, ticker Dell, gained 14.2% this week and trades around $450. Evercore ISI just raised its price target on Dell to $500, and the stock also picked up an endorsement from President Trump. But the deeper story is AI server demand. Dell is up 252% year-to-date, making it not just hot this week, but the single best performer in our entire universe for 2026. NetApp, ticker NTAP, and Broadcom, ticker AVGO, both posted roughly 11% weekly gains. NetApp is benefiting from AI storage demand, while Broadcom is entering what some analysts call a new AI growth phase. Its custom processors are in high demand as companies like OpenAI push into bespoke chip design. Broadcom also landed on a cheap stocks to buy list alongside Nvidia, which tells you the market still sees room to run even after big gains. Now let's look at the swing and recovery names, stocks bouncing from weakness, often with a specific catalyst behind the turn. CF Industries, ticker CF, is one of the most compelling. The fertilizer producer just announced a 20% increase in its quarterly dividend to $0.60 per share, a concrete signal from management about cash flow confidence. CF is up about 3% this week and 42% year-to-date. For income-focused investors, a 20% dividend hike from a basic materials company is exactly the kind of fundamental confirmation you want to see alongside a technical recovery. Regeneron Pharmaceuticals, ticker REGN, near $668, is showing recovery signs with a 2% weekly gain. The broader biotech group is getting fresh attention. Jim Cramer called biotech the hottest sector in the market right now. And Alnylam, ticker ALNY, near $313, got a direct catalyst when a competing drug from AstraZeneca and Ionis Pharmaceuticals failed a late-stage trial. When your competitor stumbles and your drug is still standing, that's a market share moment. IBM, ticker IBM, near $295, just announced major updates to its agentic AI development platform with new multi-agent capabilities. Though shares dipped today after reports that Starbucks is developing internal tools to reduce reliance on IBM software, that's a headline worth monitoring. Zooming out to the big picture, our best 180-day performers reveal which themes have had real staying power. Dell Technologies tops this list with a 274% gain over 6 months. AMD, ticker AMD, is up 163% over the same window and an extraordinary 295% over the past year. AMD's chief technology officer just spoke at a summit in Paris about a coming CPU renaissance. The thesis that agentic AI requires significantly more central processors, not just graphics chips. If that plays out, AMD's run has legs. Astera Labs, ticker ALAB, has gained 142% over 6 months and 318% over the past year. The company is riding strong demand for its PCIe Gen 6 solutions in AI data centers and just announced a significant expansion of lab facilities in Taiwan. Datadog, ticker DDOG, up 113% over 6 months, was just upgraded to a strong buy ranking as its observability platform becomes essential for enterprises managing AI infrastructure. And here's a name that bridges the short-term heat and the long-term trend. Fortinet, ticker FTNT. It's up 110% year-to-date with a very strong and steady trend, and it's also on a fresh buy signal with momentum confluence. The cybersecurity spending cycle is clearly accelerating, and Fortinet's consistent trend is exactly the kind of pattern that suggests durable demand, not a speculative spike. The common thread across all these leaders is unmistakable: AI infrastructure spending. Meta alone plans to spend roughly $145 billion in 2026 on this build-out. Whether it's Dell building the servers, HPE wiring the networks, AMD and Astera Labs supplying the silicon, or Datadog monitoring it all, the companies enabling AI are the ones delivering the biggest returns. A smart money side note to close on. Across our top picks, the latest FINRA short interest data shows the bears are mostly behaving. We're not seeing extreme short builds or panicked covers on our key names, which tells you the bullish moves we've tracked aren't being aggressively faded by contrarians. When shorts stay disciplined during a rally, it often signals genuine fundamental buying rather than a short squeeze driving prices. That's a healthier foundation for these trends to continue. Top ETF picks. Over 70 leveraged ETFs are flashing buy signals as of yesterday's close. Let's pull out the ones with real staying power. OKTG, the leveraged shares 2x long Octa ETF, leads with 3 consecutive days on buy, and it also appears in our momentum screen. So the buy signal lines up with genuine underlying momentum. That kind of confluence matters. ZETX, a 2x long Zeta ETF, also carries a 3-day streak, as does BMNG, the 2x long BMNR product. Stepping to the 2-day signal club, several names carry confluence tags. BIB, the ProShares Ultra Nasdaq Biotechnology Fund, is flagged on both the buy radar and the leveraged ETF screen. PIL, the Direction Daily Pharmaceutical Bull 3X ETF, shows up here and in momentum. NETG, the 2X Long Net Daily ETF, hits both by signals and momentum simultaneously. When a fund triggers across multiple systems, that's worth noticing. Now the critical caveat. Leveraged ETFs use derivatives to amplify returns and losses. They're for short-term trading only and decay if held long-term. Keep positions small and have an exit plan. These are short-term trading vehicles, not something to buy and hold in a retirement account or with money you're counting on. Starting with what's hottest this week. DLLL, the Granichar's 2X Long Del Daily ETF, sits at $26.83 and has surged 30.1% over the past 7 days. That follows an 812.6% year-to-date run. Dell is deep in the AI infrastructure build-out, servers, data center gear, storage, and the leveraged fund amplifies every bit of that enthusiasm. It's the only ETF appearing in both the top, weekly, and top 5 year-to-date lists, which tells you the short-term burst and the longer-term trend are aligned. NETG, the 2X Long Net ETF tracking cloud security, gained 28.1% this week with a 32.2% one-month move. Cybersecurity spending has been a quiet winner of the AI cycle. Every new data center needs protection. PIL, the Direction Pharmaceutical Bull 3X ETF, climbed 13.7% this week and 70.6% over the past month. This is classic defensive rotation. When geopolitical risk rises, money flows toward pharmaceuticals because their earnings don't depend on economic growth. Now to the year-to-date leaders. The AMD complex has been extraordinary. AMUU, the Direction Daily AMD Bull 2X ETF, is up 325.6% year-to-date and 394.6% over 6 months. AMDL and AMDG, two sister products, are right behind at 324.4% and 323.6% respectively. These all ride the same wave. AMD's positioning as the primary alternative to NVIDIA in AI accelerators. The numbers are nearly identical across all three, confirming the thesis is strong regardless of fund structure. OKTG deserves another look beyond the buy signal streak. It's up 134.7% year-to-date with a 49.6% monthly gain. Identity and access management is becoming mission-critical infrastructure. In recovery territory, CSCL, the Direction Daily Cisco Bull 2X ETF, has posted 125.6% over 6 months and 113.2% year-to-date. Cisco's push into cybersecurity is transforming it from legacy networking into a security and software story. And UTSL, the Direction Utilities Bull 3X ETF, offers a different angle entirely. Utilities are the quiet beneficiaries of the AI build-out because all those data centers need electricity. It's up 20.6% over the past year. Energy is where things get genuinely interesting right now. Reuters reported this morning that fuel markets are flashing a supply crunch despite relatively calm crude prices. Then President Trump said the Iran ceasefire is over, sending oil surging more than 5%. Energy-leveraged ETFs are responding immediately. In RGU, the microsector's Big Oil 3X ETN, is up 11.2% this week and 78.1% year-to-date. UCO, the ProShares Ultra Crude Oil Fund at $34.67, gained 7.1% this week with a 79.9% year-to-date return. Gush, covering oil and gas exploration companies, rose 5.9% over 7 days. All three show MACD bullish crossovers and golden cross formations. The technicals confirm what the headlines are driving. There's also a structural tailwind. Reuters reports governments plan to buy millions of barrels through 2028 to rebuild strategic reserves depleted by the Iran conflict. That's multi-year demand support beneath the daily headlines. For income-focused listeners, NOBL, the ProShares S&P 500 Dividend Aristocrats ETF at $56.31, holds companies that have raised dividends for at least 25 consecutive years. It's built for slowly rising income, which is exactly what many retirement portfolios need. BIB, the ProShares Ultra NASDAQ Biotechnology, deserves a final mention, up 34% over the past month with a 116% one-year return. Biotech is catching both the defensive bid and enthusiasm around drug development pipelines. Now let's look at what the smart money is doing in the leveraged ETF space. FINRA's latest Reg Show data from July 6 shows the short volume landscape. And remember, most of this short activity is just intraday market-making plumbing, not directional bets. The signal is in the extremes and in any overlap with our picks. The highest short-to-volume ratios belong to GEMG at 98.5%, BUYB at 97.6%, and FDRX at 94.0%. These are small, niche-leveraged products where nearly every trade involves a short leg that's structural, not a signal. None of these names overlap with our picks today, so there's no red flag on the funds we discussed. Looking at hedger activity specifically around our picks, short volume across the leveraged ETFs we covered is broadly normal. No major shorting spike or short covering signal this week. The technical buy signals and momentum trends we highlighted are standing on their own merit, without any contradictory smart money flow underneath. Options activity and setups. Now let's flip to the options market. First, what the broader tape is telling us about fear and dealer positioning. Then we'll bring that read back down to the individual stocks on today's pick list. Let's start with a sentiment temperature check. The put-call ratio, or PCR, compares bearish bets to bullish ones. Think of it as a fear gauge. A reading above 1 means traders bought more puts, which are bets on a decline or insurance against a drop, than calls, which are bets on a rally. Today's aggregate PCR across the major index ETF sits at 1.44, just barely above even. That's cautious, not panicked. Small caps in IWM show the most nervousness at 1.157, while the S&P 500 via SPY is nearly dead even at 1.8. Now here's the interesting tension. The SPY 25 Delta Skew, which measures the cost of out-of-the-money put insurance relative to upside call lottery tickets, sits at just 1.77 points. That's low. Crash insurance is cheap right now, almost the same price as speculative upside bets. So the PCR says cautious, but Skew says calm. Traders are buying slightly more puts than calls, but they're not paying up for serious crash protection. It's routine hedging, not fear. Now to the market makers, the dealers who sell most option bets to the rest of us. Their hedging behavior either calms the tape or amplifies it, and the key metric is gamma exposure, or GEX. Positive GEX means dealers act like a shock absorber. They buy dips and sell rallies, which dampens volatility. Negative GEX means they become an amplifier, selling into weakness and buying into strength, supercharging every move. Here's how the three major indices line up. SPY is in amplifier territory with net gamma of about minus 90.13, sitting at $751.71, roughly $7.50 below its gamma flip price of $759.23. That flip is the level where dealer behavior switches from calming to amplifying. As long as SPY stays below it, expect sharper, faster swings in both directions. Small caps tell the same story. IWM carries negative gamma of about minus 46.70, with spot at $281.98, sitting well below its flip at $289.73. Both large caps and small caps are in the amplifier zone today. But QQQ is the odd one out. The nasdaq ETF carries positive gamma of about plus 16.85, with spot at $723.28, sitting above its flip at $716.5. That puts tech in shock absorber mode. Dealers are buying dips and selling rallies, which tends to pin the index near a magnet level. Max pain for QQQ sits at $714, fairly close to current price. So while SPY and IWM could see amplified moves, QQQ should be the calmer island, at least for now. Let's look at where option prices are rich versus cheap across sectors. Implied volatility, or IV, is what the options market expects a stock to do. Realized volatility, or HV, is what it actually did. When IV runs well above HV, traders are bracing for something. Energy is the richest sector. XLE's implied volatility is running 1.3 times its realized volatility. Options are priced as if the energy sector will swing 30% more than it actually has. That premium usually shows up before a catalyst, oil inventory data, geopolitical risk, or earnings. Materials and communications are similarly elevated at 1.23 and 1.21. On the flip side, semiconductors and software are the cheapest. SOXX has an IV to HV ratio of just 0.83, meaning options are pricing in less drama than the sector has actually delivered. IGV, the software ETF, sits at 0.82. Consumer staples and real estate round out the cheap end at 0.80 and 0.76. For staples, cheap vol just means low expected ranges, a snooze. But for semiconductors at 0.83, it's more interesting. After a massive run, option sellers are pricing in calm. That's either confidence or complacency, and complacency after a big move is worth noting for anyone holding chip stocks in a retirement portfolio. Now to the names driving unusual options volume. 3 stand out for confluence, meaning they show up in today's options flow and also in other parts of our podcast framework. Broadcom, ticker AVGO, saw about 20,800 contracts trade with a put-call ratio of just 0.271, overwhelmingly bullish, and it appears in both our momentum picks and insider activity. That's triple confluence, the options tape, the momentum signal, and insiders all leaning the same direction. Apple, ticker AAPL, traded about 61,000 contracts at a PCR of 0.141, even more lopsided toward calls, and it shows up in both Senate and House trading disclosures. When options flow aligns with congressional buying on the same name, that's the kind of confirmation we watch for. Oracle, ticker ORCL, posted the heaviest call dominance of the day, about 84,900 contracts at a PCR of just 0.9. That means roughly 11 calls traded for every put. Oracle also carries an insider activity flag. Now, a PCR that extreme can be contrarian. When everyone piles onto one side of the boat, the easy money is sometimes already in. But the insider confluence adds a fundamental leg to the story worth respecting. Now let's bring that backdrop down to our picks, specifically, where in today's stock list does options positioning argue for higher prices. We pre-filtered the pick list, and here's the honest answer. 0 names qualified today. None passed the strict gamma squeeze checklist, and none carried a clear bullish positioning bias from dealer flow. The scorecard is empty, and that's worth pausing on. This screen looks for structural tailwinds, situations where dealer hedging would mechanically support a rally. 0 candidates means the options market isn't providing that hidden bid under today's picks. It doesn't mean the picks are wrong. It means they'll have to move on their own fundamentals, not on dealer mechanics. Here's what the checklist looks for so you understand why nothing cleared. A real gamma squeeze setup needs 4 things at once. First, the stock has to be below its gamma flip price. That puts dealers in amplifier mode. Second, net gamma exposure has to actually be negative. Third, there needs to be a call wall, a strike with heavy call exposure, sitting 3 to 15% above the current price, giving a rally room to run. And fourth, a put wall in the same neighborhood below, where dip buyers tend to show up as a floor. A looser second bucket catches names that fail the strict checklist but still show bullish positioning bias, upside scores well above downside. Today, nothing met either bar. That's actually consistent with the macro read. With SPY and IWM both in negative gamma amplifier territory, dealer positioning is fragile, not supportive. Fragile positioning cuts both ways. It doesn't favor the upside by default. With no individual price level maps to walk through today, the takeaway is straightforward. The confluence names from our unusual flow screen, Broadcom, Apple, Oracle, have strong bullish options flow, but that flow hasn't translated into the kind of dealer gamma structure that creates a mechanical squeeze. The call volume is there, but the dealer positioning underneath it isn't coiled. Think of it like pressing the gas pedal in a car that's in neutral, the engine's revving, but the transmission isn't engaged yet. With no positioning cards to fill the grid today, let me leave you with the bigger picture. An empty squeeze scorecard during a session where the VIX sits at 15.84 and the S&P 500 is up 0.8% tells us something important. The market is climbing, sentiment is cautiously constructive, and individual stocks are seeing real bullish options flow, but the dealer machinery isn't set up to amplify those moves into something bigger. For a retirement-minded investor, that's actually a reasonable backdrop. It means the market's gains are being driven by genuine buying interest, not by mechanical squeeze dynamics that can reverse just as fast. The risk to watch is simple. If SPY slips further below its gamma flip at $759, those amplifier dynamics switch on, and moves get bigger in both directions. Remember, this whole segment is positioning context, not a trade idea. A picks list with a gamma tailwind underneath it is a higher quality setup than one without. That's the only claim. With that backdrop locked in, let's see what Congress was doing this week. Congressional Trading. Fresh filings today show Senator Sheldon Whitehouse as the most active Senate trader with 6 new disclosures. He sold NVIDIA, ticker NVDA, in the $15,000 to $50,000 range, trimmed Apple, ticker AAPL, twice in similar amounts, and sold Crown Castle, ticker CCI. On the buy side, he purchased Micron, ticker MU, and Coherent, ticker COHR, the optical networking name riding AI data center demand. In the House, Ro Khanna filed 7 transactions, buying GE Healthcare, ticker GEHC, Bank of Montreal, Lincoln National, Cooper Companies, and Uber, while selling Owens Corning and Penn Entertainment. Representative Richie Torres disclosed a McKesson purchase dated January 2025, an unusually long reporting gap. The weekly cluster data reveals an unusually coordinated pattern. 2 House members, Gilbert Cisneros and Ro Khanna, bought the same 8 stocks this week, including Eli Lilly, Abbott Labs, Boston Scientific, and Apple. That kind of overlap between just two members is rare. Over the past 30 days, Hubbell Incorporated, ticker HUBB, drew 7 buys from 2 members, the most accumulated position in the House. The broader 30-day picture shows both chambers leaning bullish. The House posted 225 buys against 97 sells, a strongly positive tilt. The Senate is nearly split even, with 24 buys and 23 sells. On the selling side, Nvidia and Amazon each drew 3 House sellers, while Westinghouse Airbrake, ticker WAB, saw 4 sells from a single member. The pattern suggests Congress is rotating toward healthcare and industrials, while trimming megacap tech exposure. Insider activity. The standout story this week is at Simon Property Group, ticker SPG, where 11 insiders made 28 separate purchases totaling about $533,000. That many insiders buying the same stock at the same time is the closest thing to a consensus vote of confidence you will see from inside a company. Beyond that, Adobe, ticker ADBE, saw a single insider purchase worth roughly $1.95 million. Now for the broader mood. Over the past 14 days, insider buying has been running severely subdued. The buy-to-sell ratio sits at just 0.4, with only 42 buy transactions against 1051 sells. Most of that selling is routine, tax-driven, and diversification-related, not signal. But the lopsided ratio does tell you insiders are not exactly racing to add to their positions at current prices. The single largest non-index mega buy comes from Jefferies Financial Group, ticker JEF, where Sumitomo Mitsui Financial Group poured roughly $352.5 million into the stock. When a major financial institution commits that kind of capital in one move, it is a strategic bet, not a casual allocation. And that is the key point for long-term investors. Insiders and strategic buyers know their businesses better than anyone. When you see a coordinated cluster of insiders buying, or a single buyer dropping hundreds of millions, those are the signals worth watching. Federal budget. Through July 8th, the government spent $282 billion against just $102 billion in net receipts. That's a $180 billion deficit in 8 days, running $48 billion worse than the same period last year. That gap isn't a one-off. It's the monthly snapshot of a structural mismatch between what the government collects and what it's committed to spend. The top 3 line items tell you why. Health and Human Services at $116 billion, Social Security at $65 billion, and then interest on the public debt, which already exceeds the entire Defense Department budget at just $21 billion month to date. When your financing costs rival your military spending, the math starts constraining everything else. On July 8th alone, $32.9 billion in Social Security benefits went out the door, a reminder that these obligations don't pause for fiscal debates. Step back to the full fiscal year and the arc comes into focus. Receipts of $4.56 trillion against $5.77 trillion in outlays. A $1.21 trillion deficit that's actually 4.3% better than last year, mostly because tax revenue is up. But better is relative. The full-year pace still points to a $1.87 trillion deficit, and the decade view shows why. Spending jumped during COVID and the baseline never came back down. Receipts recovered, but outlays found a new floor. The starkest illustration is interest expense, $466 billion in 2017, then $1.15 trillion in 2024, $1.27 trillion in 2025, and now on pace for $1.39 trillion. It has tripled in under a decade, and unlike discretionary spending, it cannot be cut. It is the price of yesterday's borrowing, and it's crowding out everything tomorrow. The total debt stands at $39.4 trillion. That number is abstract until you make it personal, roughly $118,000 per citizen, $263,000 per taxpayer. Each new trillion arrives faster than the last. The jump from $38 to $39 trillion took just 4.8 months. At this pace, $50 trillion arrives by June 2029. Measured against the economy, debt to GDP has climbed to 123%, well past the 100% threshold that historically signals fiscal stress. Over the past year alone, the total grew by $3.2 trillion. The debt did dip about $20 billion between July 7th and 8th. That almost never happens, and it won't last. Who holds this debt? Private domestic investors own the largest share at roughly $27 trillion, about 69%. Foreign investors hold $9.3 trillion. Japan leads at $1.2 trillion, the UK at $938 billion, and China has been steadily trimming its position, now third at $651 billion. That diversification matters. If foreign buyers pull back, Domestic investors and the Fed have to absorb the difference. But the real story is the rate environment. The average interest rate on marketable debt has climbed from 2.87% in mid-2023 to 3.41% today. That 54 basis point shift, applied to over $30 trillion in marketable securities, is exactly what produced the interest expense surge we saw in the last chart. And here's the trap. About $7.4 trillion, nearly a quarter of all marketable debt, reprices within 12 months. Treasury bills and floating rate notes that roll over constantly. Every 25 basis point increase adds roughly $18.5 billion in annual interest. A full percentage point adds $74 billion straight to the deficit, which adds to the debt, which means more interest next year. The government has essentially financed itself with an adjustable rate mortgage, great when rates were at zero, costly now. The longer rates stay elevated, the more legacy low-rate debt rolls into today's higher environment, a feedback loop feeding on itself. Week ahead. Next week is one of those weeks that reminds you why summer isn't quiet on Wall Street anymore. We've got a wave of bank earnings, a critical inflation report, and one of the largest foreign company listings in U.S. history. Let me walk you through it. Starting with earnings because this is where the action is. Tuesday, July 14 is Financial Sector Day. 5 major banks report before the bell. J.P. Morgan Chase, ticker JPM, Bank of America, ticker BAC, Citigroup, ticker C, Goldman Sachs, ticker GS, and Wells Fargo, ticker WFC. That's a powerhouse lineup, and for retirement investors, these reports are your temperature check on the broader economy. Banks tell you whether consumers are paying their credit cards, whether businesses are borrowing, and whether net interest income is holding up. Also reporting Tuesday is Fastenal, ticker FAST, an industrial distributor that's a reliable barometer for manufacturing activity. Wednesday, July 15 keeps the financial momentum going with Morgan Stanley, ticker MS, and BlackRock, ticker BLK, the world's largest asset manager. Johnson & Johnson, ticker J&J, also reports Wednesday, giving us a read on healthcare and pharmaceutical demand. We'll also hear from United Airlines, ticker UAL, which offers a window into consumer travel spending, plus ASML, the Dutch semiconductor equipment maker, whose results ripple across the entire chip supply chain. Now let's talk economic data. The headline event is Tuesday morning's Consumer Price Index for June. Year-over-year inflation is expected to come in at 3.9%, down from 4.2% in May. The monthly figure is the one to watch closely. Economists are forecasting a slight decline of 0.1%, a sharp pullback from the 0.5% jump we saw last month. Core inflation, which strips out food and energy, is expected to hold steady at 2.9% year-over-year. If these numbers land as expected, they'll reinforce the case that price pressures are gradually cooling, though not yet at the Fed's target. Chicago Fed President Austin Goolsbee speaks Tuesday afternoon, so expect markets to parse his reaction carefully. On Monday, OPEC holds its monthly meeting, which could move oil prices. Also Monday, the Treasury releases the June budget statement. Finally, on the IPO front, the big debut happened this afternoon. SK Hynix, ticker SKHY, the South Korean memory chip giant, began trading on nasdaq. This is being called one of the largest foreign company share sales ever in the U.S. Bloomberg reports demand was oversubscribed more than 7 times over, drawing heavy interest from long-only funds and tech-focused investors. For anyone watching the AI trade, SK Hynix is a major supplier of high-bandwidth memory used in AI chips, so this listing is worth your attention. It's shaping up to be a pivotal week. I'll be right here breaking it all down as the numbers land. That's your week ahead. As we near the end of the podcast, the key takeaways are: the labor market is bending, just 57,000 new jobs in June against 4.2% unemployment. With margin debt near $1.42 trillion and inflation still above target, the Fed stays frozen. The one thing to watch next week: Tuesday's CPI report and bank earnings, which together will reveal whether the economy is cooling gently or starting to crack. For interactive charts and all the numbers behind today's show, visit stockbeaver.com. Thanks for joining me. I'll see you tomorrow.